and welcome back to another video. I really do appreciate you watching. Please do subscribe if you like what you see. I really do appreciate it, and I notice everyone that subscribes, I see it all. So I would really appreciate it if you could please help me out and subscribe. So let's get into it. Here's another video. This is actually a video that I've been waiting to do for a while. This company, Celsius, are like the drinks that you see everywhere that kind of look like a Monster or an Amp or a Red Bull. And it reminds me a lot of Monster as a company. I think Pepsi owns like a small stake in Celsius, but basically this company has taken the country by storm, and I will go over a few fun facts, including how long this has actually been trading for. It's not like it just popped up yesterday. It has been around for quite a while. So let's start out by looking at it. The stock, as far as what TipRank says, is an outperform. It's a 9 out of 10. So we don't like to look at anything lower than a 7. You know, 7s are like the baseline. Like, you should probably think about investing in this. But like a 9, that's good. That's what we want to see. Along with all of the compiled analyst forecasts, we can see that it is a strong buy with 10 buy ratings, no hold, no sell. It's got about a 6% upside as far as where we are today on July 9th, 2023, which isn't really that much, but you can just see that Celsius has been on a tear for a while. And so we can also see, when we start to look at the financials of it, that sales have basically doubled from December 2021 to December 2022. And that's really good. Sales have basically doubled for the last 4 years, from 2019 all the way through 2022. Every year it's basically doubled, and it actually, I saw a forecast, is expected to be about about like 1 to 1.1 billion for 2023. So this makes sense. The only unfortunate part is that with this monster growth, they've had a huge unprofitability. In the latest 2022, most likely because of all the marketing and just the cost of selling all those cans in that product. That will catch up to a growth company like this really quickly. If you can't handle that much growth quickly, you'll see something like this where it goes unprofitable for about a year or two. So I guess we'll have to see what happens at the end of 2023, because this was the end of 2022. And if we actually look at their balance sheet, this is a really good balance sheet. So you can see that there's about 917 million in total current assets, or about 1.2 billion in total assets, but current liabilities is only 161 million. Like, you have 917 million versus 161. That's really good working capital. You can pay all your bills right now if you need to. Anything that comes up short term, you can definitely pay for. And then as far as long-term liabilities goes, this is what we really like to see, is that there's no long-term debt, but the other non-current liabilities is kind of concerning, because we just saw great working capital, no long-term debt, but assets are 1.2 billion, and then total liabilities is about 1.1 billion. So I don't know what's in here. If you can comment and tell me what it is, that would be great. But other than that, that is, kind of concerned to have something like that. And then as far as the cash flow statement goes, for the annual cash flow statement, we see things like, debt repayment. I guess that they might have had a little bit of debt here and there, maybe like 63 million, 94 million, 9 billion, something like that. So they have been paying off their debt. Sorry, I should say 9 million, not 9 billion in debt. The company definitely doesn't have 9 billion in debt. But you can see that they paid a special dividend of like 11 million in 2022. So that tells me that the company grew so quick that they probably had to pay out some type of cash. Maybe that's why they're also unprofitable. They probably had some type of growth plan here that they had to pay a special dividend, because you don't see a dividend any other year. So that was executed as like a special dividend. And they don't really issue too many new shares, which is really good, but they also don't buy back any shares. Maybe that will change one day again once they start to get a better hold on their cash flow. Maybe they can actually start to do that. They do have free cash flow, which is a good sign. They can create it, so that's really good. And now the fun fact for you is that Celsius actually has been trading since like the data goes back to February 2007. That's probably when they IPO'd. So they've been out for about 16 years. This is pretty good. Um, and you can actually see that, like, like a typical small company, they had like huge return in their second year of being public. But then they just kind of dwindled, and then up until like 2020, when they absolutely boomed. I believe this is when everything got like really popular with them, and they just kind of skyrocketed into like marketing and into everyone's life. It's like the next Red Bull kind of thing. That's what it feels like. But either way, if we just look at what happened with a portfolio of Celsius, just from investing $10,000 initially 16 years ago, you'd have 466,000, which is a 28% compound annual growth rate. So let's actually try to see if this gets a little bit better. Let's see what happens if you had invested in 2022 $10,000 in the company. Let's see what you would have. You today would have 20,000. So that's pretty good. You doubled your return, which is a 58% compound annual growth rate. That's what you want to see. That's pretty good. That's a pretty good CAGR. That's a pretty good, from one year to the next. Not everything that you invest in will ever return 100% within a year. That just doesn't really happen. So this is definitely a trendy stock. It's one to be warned about. But at the same time, now you know what the financials look like. So hope you guys enjoyed this video, and I'll see you soon.